Hi, I'm Janine Purves, and I'm the Chief Financial Educator of Waverley Wealth. Waverley Wealth is a platform that helps everybody to make a better financial decision one day at a time. We're really hoping to get Canadians financially literate and making great decisions so that they are all in better position tomorrow than they were today. And today I'm really excited to talk about a huge issue that I think is so important, and that is getting your first mortgage, buying your first house. It's something that we all strive for and hopefully we can do, but it's really important to be on track. And our guest speaker today is Rina D'Avino, and she is a mortgage professional with over 20 years in the business development industry and sales, and she's going to share with us some tips on how to get your first mortgage and what you need to do. So thanks so much for being with us today, Rina.
Thank you, Janine. It's a pleasure. Thank you.
I'm really excited to hear what you have to share, because all I ever hear about is what rate everybody's getting, and especially because interest rates are so low right now, that rates are everything. So I know there's more to it. And obviously rate's important, but maybe you can share with us what are the key things people need to be looking at when they're considering a mortgage.
Absolutely. Yeah. Rate is always the first question I get asked, but there are other factors indeed. So I would start off with your term. So the mortgage term is the length of time your mortgage contract is in effect. It consists of your mortgage contract, what it outlines, and it includes the interest rate as well. And the terms can range anywhere from 6 months to 5 years or longer. And at the end of each term, you have to renew your mortgage because you're most often not paying your complete mortgage in full after that first term. It's going to take you multiple terms to repay your mortgage.
That would be true with the Toronto prices for sure, right?
For sure, without a doubt. Toronto, without a doubt, or everywhere in Ontario, it seems like it's just expanding farther and farther away. But your length of your mortgage term has an impact on the interest rate and the type of interest you can get, whether it's fixed or variable, the penalties you have to pay if you break your mortgage contract before the end of your term, and how soon you have to renew your mortgage agreement. So after term, I would say your amortization. The amortization period is the length of time it takes to pay off a mortgage in full. So the longer the amortization period, the lower your payments are going to be. Keep in mind that the longer that you take to pay off your mortgage, the more interest you will pay. So even though your rates will be less if it's longer, if it's a 30-year amortization, but it is going to be more in interest. And the other thing,
I want to ask, what is the longest amortization period that's available these days?
You know what? Usually it's 25 or 30 years. That's the most common. You do see 30. There's some lenders that have other extended amortization periods, but I would say generally 25 to 30 years is what we look at here in Canada.
Okay.
And the other keynote I wanted to say is if your down payment is less than 20%, the longest amortization that is allowed is 25 years.
Interesting. Yeah, you're paying less, but you don't get to spread it out over a longer time.
No.
Okay. Are there any other items to be watching for?
Yeah, the other big item and topic of conversation often is fixed interest rate versus variable interest rate. So a fixed interest rate stays the same for the entire term. Often the rates are usually a little bit higher on the fixed rates. But with fixed rates, your payments will stay the same for the entire term. And a lot of people have comfort in knowing that they're going to have the same payment for the entire term. The other option is a variable interest rate, and a variable interest rate can increase and decrease during the term. Typically, the interest rate is lower with the variable interest rate than a fixed interest rate. And you can keep your payments the same for the duration of your term. Lenders call this a fixed payment with a variable interest rate. Or you also have the option of an adjustable payment with the variable rate. And the adjustable payments means that basically your amount, the amount of payment can change if the rate changes.
Okay.
And the other factor I want to say is payment frequency. So you have the option of going monthly, semi-monthly, bi-weekly, weekly, accelerated bi-weekly, and accelerated weekly. So you can choose accelerated payment schedules. This will basically save you tens of thousands of dollars over the term, over the life of your mortgage if you have accelerated payments or if you put in those extra payments. And most often people do that. They like to put in, extra payments to get that payment lower.
Okay. So I guess if they're looking to get their first mortgage, what are the most important things that they need to do to prepare for that?
Okay, we just previously had the credit score segment, but I'm going to talk about it because this is really important, and it's check your credit score. It is really important that you know what your credit score is, because most lenders will use your credit score to gauge your financial trustworthiness and ability to repay your debts. So the higher your credit score, the more likely you'll be offered lower interest rates. And ideally, you want your score to be at least 680 or higher. Higher is always better. And in addition to your overall numerical score, your credit score will contain information about your late payments, the number of accounts you have, your overall debt levels, and your credit history. So making your loan and bill repayments on time and not using too much of your available credit. This is what lenders are looking at. So really important to check your credit score. Okay. And next, I would say your down payment. So the larger the down payment, is the better, I guess. Buying a home will always require some amount of cash up front. And the reason why the larger the down payment, the better is because, well, first of all, you're going to have a smaller mortgage. You'll need to borrow less money, obviously, and you'll pay less interest. Getting approved on a mortgage relies on the down payment. So what you're looking at, minimum down payments, and there's different categories, but I'll start off with saying, if it's a home purchase of less than $500,000, the minimum down payment is 5% of the purchase price. If you are looking at a home that's valued between $500,000 and $1 million, you'll need 5% of the first $500,000 and 10% for the portion of the purchase price above the $500,000. And if you have a purchase of over $1 million, which isn't really hard to get these days, you're going to need 20% of the total purchase price.
Okay, so pretty demanding in terms of savings, for sure.
Well, the price of homes these days, absolutely. And if you are putting down less than 20%, you're buying a home under $1 million, but you will also have to get mortgage loan insurance. And these premiums will increase your monthly mortgage. It's going to be added to your mortgage payment.
Okay. So important to be able to get to that 20% point so you're not paying the extra premium.
But, you want to get in the market. So again, the longer that you wait, it just seems like it's a catch-22 because you want to save more, but the price is just keeping.
That's true. Yes, I've seen a few of those cases.
It's sure. Crazy market. Yeah. Sure. The other thing to really keep in mind is to keep your income stable. So while you're applying for a mortgage, it's really important to keep your job. Mortgage providers won't approve your mortgage without proof that you can make your payments. So a full-time job when you're not on probation is the best way to prove that. It guarantees your income long-term, and having been with an employer for a longer time will also help with your application. If you're applying for a mortgage with your partner, both of you having a full-time job is ideal. Okay. And things have been really unsteady and unstable with the coronavirus. And as long as that's, happening, I think it's really important that you just keep consistency, because if a lender thinks that there might be some issues down the line, it might be a problem. So don't be changing jobs, and it's good to keep that at least going as long as that application is going. The other really important thing is to pay down existing debt. Taking on a mortgage means taking on some long-term debt, so you'll want to minimize your existing debt. Once you get your mortgage paid, it will be much easier if you don't have other debts to service, obviously. So it's important to keep your debt in balance and keep it low.
So when I literally had a few situations recently where somebody quit their job and was going self-employed right before they were ready to buy a house.
Yes.
That might not be the ideal situation, I would guess.
I would definitely do it after. If you're going to be self-employed, they're going to be looking for a 2-year history. So when you don't have that, and that includes, notice of assessments, full tax returns. So you don't want to start a new business or leave your job right now, like right away. I try to do it afterwards, and hopefully it all goes well. And you can continue making your payments, but definitely not a good idea to make any changes to your income.
Okay. And I know somebody else, and they went and bought a car right before they were buying this house.
Yeah, extra debt.
And I'm like, they're putting more credit, using more credit, which meant they might qualify for a smaller mortgage because they've used up that much. Is that correct?
Absolutely. Absolutely. 100%. So you can be declined based on, I had clients that you know, there's two people on the application and they both had new cars, and the ratios just didn't end up working, and they were approved for a lot less. And it was just, they should have waited until after they got their mortgage approval and then purchase their cars if that was in their budget. But yeah, definitely keep that to the side while you're applying for a mortgage, and really get a mortgage pre-approval. These days, especially, we know how crazy the market is. You want to get a pre-approval. Pre-approvals are valid for 90 to 100 days. So it gives you that time to find a home without losing a great mortgage deal. So you really want to be able to keep that in check.
Okay. This chart you provided just as a guideline in the first 10 steps of buying a house. Did you want to just touch on it?
Yeah, absolutely. As I mentioned, and I just finished saying, pre-approval, that's the first step. I think a lot of people go out and think it's just, you know, let me just go out and start looking for a home. But really the pre-approval, you don't want to be disappointed, because it can be really disheartening to get out there and only realize that you're only going to be approved for a lot less. So getting that pre-approval really is the first step. And I think the best bet would be to speak to a mortgage professional, because they can definitely guide you as far as telling you how much you can afford. And, you know, when you talk about it, we talk about a lot of different things that we touch on when we talk about what you can afford and getting that pre-approval, because it's not just the mortgage. There's going to be other things that come along, like just living costs, your debt repayments, any other obligations. So it's really important to be honest with yourself about what you can afford. You know, it's lifestyle needs that you might have. So childcare, you know, groceries, supporting your parents, if that's the case. You know, there's just a lot of different things that people need to consider. So don't stretch yourself too thin. It's really important.
As a financial planner, this is one of the key things that I look at when everybody's taking on any shift in their expenses or lifestyle. And taking on a mortgage is just as important, because often they have all these ideas and dreams of what they're going to do to the house, but the mortgage might be more than the rent, and you're not going to have the money to do that. So I also realize that there's another side of this. As you said, pre-approval, there's certain steps that now I believe have been added with regards to getting approval for a mortgage, where it's affected how much people are getting, because there's sort of a stress test or something. Can you talk about that?
Correct. Absolutely. There is a stress test. So it's really important. These are some of the criteria that are required. So what in today's world, lenders use a stress test, and it's a rate of 5.25% to qualify the prospective borrower. So you might be getting a really low rate of 2% or under 2%. But if you can't qualify at 5.25, I mean, you're not going to get that mortgage approval. So it's really, really important that when we do the calculations, we're basing it on a 5.25% interest rate. And that should rates go up, and they just want to cover everyone and make sure that you're not going to not be able to pay your monthly bills and your mortgage bill.
Right. It seems like a tough go, because I get they are likely to go up. You want some protection in there, but it seems almost more extreme than maybe it needs to be, especially if you're young, and hopefully our income is going to increase, you know, as we get more seasoned and build up on our career, right?
Absolutely. That's, I think, one of the biggest frustrations, because that mortgage is over the span of like 25 years. So, you know, I mean, you hope that your income will increase throughout the course of those years. Yes. But yeah, they're definitely making it definitely tougher. 5.25 it was up until, I think, last year it was 4.79, but they increased it to 5.25. Okay. The other criteria that they look at these days is, I mean, your ratios. So I don't know if you've heard of ratios, but it's your ratios. The lender wants to see a maximum ratio of 39-44, and that's what a mortgage professional will discuss with you when you're sitting down and looking to see how much you qualify for. Your gross debt service ratio is calculated by adding your total monthly housing costs. So this will include your principal, which is the amount you borrowed, your interest, property taxes, and the estimated amount of heating, plus 50% condo fees if it's a condo that you're purchasing, and that's divided by your annual income. So this shouldn't represent more than 39%. And then you go to your total debt service, which is your TDS, and I don't want to get too technical here, but it's what I mentioned, just including your principal and interest, your property taxes, and the heating, and any condo fees if applicable. But it also includes all other credit payments that you have. And then that's divided by your gross annual income, and that shouldn't be more than 44%. So that's why we talk about debt and keeping it low, because it's going to be factored into your ratios. So really important.
Okay. All right. Did you want to touch on anything else on this chart?
Really, as far as the 10 steps, yes. So once we get that pre-approval going, I mean, it's pretty, you can see the whole chart and it's pretty self-explanatory, but really important to work with people that you are comfortable working with. So when you're starting your house hunting, you know, finding that realtor that you're really comfortable with, and, you know, getting out there and doing your homework, I think is really important. I mean, there's multiple offers these days, and as you can see in the chart, you know, your offer is accepted. If it's that easy, because I know that I've got a lot of clients that have, you know, put in, you know, 3 or 4 or 5 different offers and they're still searching. So not that easy these days, but once your offer is accepted, you know, you have to also take into consideration home inspection fees perhaps, or an appraisal, and other improvements that you're going to want to do. So keep that in mind. Then you've got your approval. There's lots of documentation that is required. I really didn't touch that too much, but you know, you've got to be able to provide pay stubs and tax returns and things like that to make sure that everything is in line with what the lender is wanting to approve you for. That's the document collection. So get organized, I think, is really, really important when you are looking at a house, because things can happen quite quickly. So you just want to make sure that you have everything collected and ready to go. Gift letters, I think these days, I just want to touch on that really quickly, because these days I think a lot of young first-time home buyers are getting support and help from their families. So gift letters, things like that. I mean, these are all things that will eventually take place, but things to consider. So, you know, okay. I think that there's a lot of, there's definitely a lot of steps, but the pre-approval is the most important, and then you just kind of move along.
Okay. All right. Well, I think we've covered a lot. Is there any final tips that you want to leave with people in getting their first mortgage?
I think I just mentioned it, really getting organized is one of the key, and working with people that you are comfortable working with, saving for that down payment, and just not, I think, missing out. So they're really wanting to jump, and sometimes people do get caught in situations where they have buyer's remorse. So take your time, be patient. Things hopefully will get better as time goes on, and watch your credit score and your debt.
Yeah. And I'm going to touch on one thing is, I think we talked about when we did our credit score session, you mentioned that it is important to tap into it, try to tap into it only once, because you don't want tons of inquiries. And frankly, by working with a mortgage broker, you guys can shop around and actually help people get the best rate, and also maybe take a little bit more time than you will with somebody who doesn't have an option of doing that. Is that a fair statement?
Yeah, absolutely. I think that, you know, we don't have, it makes no difference to us what, where we take you. We just want to make sure that we put you we want to make sure and value your financial goals and look at the big picture down the road. So let's talk about what's your exit or your plan. Is it a 5-year plan? Is it like long-term, short-term? Are you looking to, is this an investment property? You know, we've got different lenders that we work with and different strategies that we can consider. And it's really important to go over what your goals are and where you see yourself down the road. Is this just, you know, first time, temporary home? There's lots of different factors that we can touch on.
Right, which is why it's so important to get the mortgage that fits your priorities and have a broker that can help make sure that that's all lined up.
Every situation is different. Everyone's situation is different, absolutely. And you should really consider your own personal needs and what you're comfortable with. So it is important to discuss these things with a mortgage professional.
Right. Well, thanks so much for your time, Rina. With the hype in the market that's going on at the moment, and who knows when we might see a shift, it's really important to stay on track for what you have already been approved for and not get too caught up. So make sure you are working with professionals that are helping to keep you on track for that. And as a financial planner, I can tell you that reviewing cash flow, reviewing all those steps are really an important part as well at the beginning of the process. So thanks for your time today, Rina. I hope everybody got a few tips in mind, and make sure you go get that paperwork in order. So when you actually need to do it, you are in perfect position to move ahead quickly and can take advantage of buying that perfect dream home. Thanks for your day. Have a great time.
Thanks so much. Good luck. Bye-bye.